think we're going to continue on with what Fraser started with. Was just going to dive a little bit in the asset class, comparison of private versus listed, talk a little bit about the outlook, some of those allocation questions, and by all means, we're small enough and comfortable enough to have anybody interject or ask questions. But Manoj, why don't we start with you, of course, as our host. Thank you for having us. This great facility. Maybe can you help just set the stage and tell us what you're seeing in the GLI marketplace, kind of broadly. Obviously, there's multiple sectors and there's multiple geographies, but maybe just share some thoughts in terms of kind of lay of the land of what's going on broadly in global listed infrastructure today.
Yeah, absolutely. I'd say the marketplace is healthy. We've, as I mentioned, we've had this sort of evolution over the last, 15, 20 years. And really the last 5 years was kind of the period of time where I feel like the asset class has broken out. And I think part of it just has to do with we've gone through like a major cycle and the asset class has been tested. And, we've always talked about things about, okay, listed infrastructure, behaves like private infrastructure, the benefits of owning listed infrastructure, the inflation protection aspect, the resiliency of the cash flows. And, all of those statements have gotten tested, over the last 5 years. We went through, a dramatic, downturn in the economy, and we were able to see and show that, there was, a significant portion of infrastructure companies were able to maintain, their cash flows. And then we've been in this environment of, a significant increase in inflation and interest rates. And we were able to see, obviously, how parts of infrastructure have been much more resilient, particularly the energy, and the transportation side. And so, and then you couple that with just the growing allocations to infrastructure in general. And I'm sure, Chris and Ashli will talk about just, some of the challenges on the private side. But, I think clearly listed has proven to be a good complement within that space. And, I'd say most of the growth I think we're going to see in the asset class is going to be primarily coming from institutions, and realizing some of the benefits and now being a little bit more comfortable with the history, both the pluses and the minuses, right? I mean, we're obviously in a tough, interest rate environment and valuations are falling and things like that. But I don't think anybody is surprised that, when interest rates go up, the value of long duration cash flows, falls. So I would say overall, like this has been a very good, healthy environment, for the asset class to be tested.
And maybe so it sounds like if you were giving GLI a grade the last 3 years, you'd give it a good grade, A minus?
Give it a B minus, right? But which might be a little just, I think the one unfortunate thing is just some of the volatility, probably particularly the last like 18 months was probably a little too excessive. And I would argue that private infrastructure valuations are not accurate today. But I think that's where, again, I think we just need to go through the cycle. And but I have no doubt when you look at the fundamentals of our companies and what they're doing, yeah, maybe the price doesn't in some cases reflect the value, but I'd say some of the volatility more recently has probably just been a little extra than would have wanted. So
yeah, gotcha. Jim, just continuing on that theme, when we had inflation, so we did COVID and GLI is normally more defensive, except transportation got hit. So that would be maybe the anomaly that kind of bucked the trend of being defensive in down markets. Then we had inflation. GLI seemed to perform pretty well. But this year it's been higher rates and that's been maybe a little more challenging. So I don't know if you can drill down a little bit more and talk about rates and maybe I don't know if you can give an example from different sectors, but maybe talk about how these companies are kind of handling higher rates, how they're dealing with them.
Yeah, it's been the dominant theme, obviously, over the last 18 months. And, you can take your own view on where they're going to go from here. But I think probably the opportunity in the sector, maybe in the next 18 months, is as rates plateau and maybe begin to roll over, and that'll expose some really, really attractive valuations. I guess, I mean, regulated utilities is an area where it varies whether you've got inflation protection. You know, some of the UK, my home market, you know, the stocks, the assets, the underlying assets do have linkage to inflation in returns. Obviously, in the US, it's a little bit more nuanced by asset, by state. But again, you know, I think the underlying earnings picture and cash flow picture has been strong. And the fact is, you know, even US regulated utilities without explicit inflation protection are still growing their dividends, you know, 4, 5, 6, 7%, which, you know, even in a high rate environment is an attractive proposition. But I guess the rate opportunity, the real opportunity, I think, is that a lot of our stocks now are really, really cheap, I think, personally. And, you know, that overreaction, while, you know, I echo Manoj's point, it's not particularly good on a day-to-day basis to be marking down the value of your portfolio. The opportunity it creates for new money coming into the listed infrastructure space, I think, is profound. Perhaps the best opportunity, you know, in my almost 20 years of managing money in this space.
And do you think companies generally have handled the increase in rates well because they were prepared for it, because their business model accounts for it? In other words, sounds like you're saying there is a disconnect between fundamentals. Can you just comment on the fundamentals versus maybe the prices have been weak, but how are the businesses doing?
Yeah, these are long-term assets with long-term returns, regulated returns, contracted returns, inflation linkage. You know, when obviously you invest a lot of capital, you know, you invest over a long period of time. You want that return environment. So there's a lot of escalators in place. And yeah, I think, you know, generally the companies have handled it very well. There's clearly, you know, in renewable energy, you know, let's say Ørsted is an example of a company that's handled it not so well because they've signed up to fixed price PPAs and not locked in the costs, which are clearly inflating, whether it's the cost of debt or the cost the supply chain costs. So some companies not so much, but generally I think, yeah, really well.
Yeah, good, thank you. And I do want to come back to that renewables issue, but maybe we'll come back to it at a later time. Chris, maybe just drilling down kind of to kind of real assets where GLI tends to sit. Can you tell us how Goldman Sachs looks at real assets? Maybe are there things you include or don't include that others do? And how do you think about real assets allocations, and then maybe where GLI fits within that?
Yeah, happy to. So we think about real assets a little bit differently depending on client channel. So broadly speaking, we work with ultra high net worth private clients and large institutional investors. And the way we position the asset class sort of differs depending on those groups. For our private client channel, GLI sort of sits in what we call like an income-oriented bucket. And this is a sort of a sleeve within you know, a multi-asset class portfolio, kind of ranges from, call it 2 to 5%. And the idea is the sleeve should generate some level of current income. So GLI sits on the shelf kind of alongside REITs, MLPs, sort of just broader global equity, sort of dividend-oriented strategies. And that's how it's sort of positioned in client portfolios, and, you know, advisors and clients kind of work together to figure out which of those sort of ways to allocate makes the most sense, and sort of how to size it. You know, I think candidly, the last several years, it's been a tougher sort of uptake environment within that population, really kind of across all those food groups. You know, if you think about that income-oriented bucket, it's competing against other asset classes, private markets asset classes on the liquid side, some growth-oriented strategies. Tech has obviously done very well. So that entire bucket has been a little bit of a tougher conversation with clients. But generally speaking, if clients are interested in some sort of income generation on the equity side of the portfolio, they will think about accessing it that way. On the institutional side of the business, that's where we have probably the most demand and the most sort of consistent level of demand. Institutional clients really see the value in having sort of dedicated real estate infrastructure and other real asset sort of category allocations in the portfolio, both on the public and on the private side. So most institutions, when they come in the door, we're designing a customized allocation for them. They generally are amenable to allocating to the asset class, and we generally give them sort of a mixed portfolio of sort of dedicated GLI strategies and REIT strategies as well. Challenge there kind of most recently is with those institutional clients, just given sort of the market movement, and a lot of our institutional clients are pension plans and funded statuses are rising. There's sort of been this move to de-risk and reallocate capital across sort of the entire quantum of assets. So ironically, even though the sort of micro conversation around GLI has gotten more interesting for that client base, it's actually been a bit of a tougher near-term environment as money is going into fixed income. Pension plans are annuitizing their liability stream and things of that nature.
And does Goldman have any kind of top-down view on inflation, that inflation will be more sticky or less sticky, that kind of influences and trickles down to some of those decisions? Or is it more asset class or a combination of both?
Yeah, it's always hard to articulate what the Goldman view is because there's sort of competing groups within the firm that sort of traffic in sort of macro forecasting. I think, generally speaking, I think we're of the view that inflation, it's down to the kind of 3s and 4s now. That's probably about where it stays, kind of for the short to medium term. And we think the rate environment is probably higher for longer, higher than the market is, higher and longer than the market is probably appreciating. But at the same time, I think our macro economists and strategists have been constructive on the economy. At the beginning of the year, I think sort of the consensus view was there was going to be a recession at some point in 2023. And a lot of our macro forecasters were, more optimistic that we could avoid that, and they've continued that. So I think, we're in the bucket of, higher rates for longer than the market's probably appreciating. Inflation probably is sticky at this, kind of 3 to 4% level, but that doesn't necessarily mean a recession kind of in the short term.
Yeah, and I think there's more people are probably coming around to that view that inflation's not going back to 2%. It's going to stay a little more sticky, a little higher levels than we've seen, and maybe that's good for real assets kind of on a secular level. So thank you for sharing that. Ashli, all that's a kind of a setup to get to you to kind of set the table to think about infrastructure allocations. So maybe we could just start, we'll drill down a little bit more, but if you want to just start with how are investors looking at infrastructure allocations? Chris did touch on that, but from your perspective at Albourne, and then I want to delve into the public versus private, if you want to jump into that. So infrastructure broadly, and then how are they thinking about each?
Yeah, sure. So the good news is, because it keeps things interesting, we advise to about 35 billion in real assets portfolios, and no two of those portfolios look anything alike. And so, I think in general, when people think about investing in infrastructure, it kind of follows 3 paths. One is maybe it sits within kind of this dedicated real assets bucket. And when you have that, you can really invest across the whole risk spectrum of infrastructure, all the way from core to the value add side, or even the opportunistic. What I've seen a lot also come up is it sits kind of as it competes for capital against private equity. And so when it does that, it's still, you can build a portfolio about it, but it's going to push you out in the risk spectrum. And that's really an area, if you think about value add and opportunistic infrastructure, that's an area that really has grown a lot over the last even 2 years. I think, what we say now is included in infrastructure is really a whole lot of investments that kind of very much walk up to the line of private equity, and sometimes really kind of maybe put their toes over it, right? And then there is another group that kind of maybe has their infrastructure sit within a inflation bucket. And when you have that kind of an allocation, that really is going to push you more toward the core end. And so, more the core plus is where you'll end up kind of staying. And so when we see it all, and fortunately there is, from super core all the way out to, the folks investing in amusement parks, you can kind of, there's something for everyone. In terms of the listed and the unlisted, it's the same story. It really runs the entire spectrum. Some don't think about it at all, and they go and they are putting their capital to work, and they think about it in terms of private only. There's also some that kind of leave it to the public equity team, right? So they think, we're fine to have it. We have an allocation to it, but we don't really look at it. It's handled by our public equity guys. And then there are some who see it very much as a complement and, as a strategic allocation. And that's actually, when I was building out the program at South Carolina, that's how I viewed it. I was starting from scratch. And so, with the help of Manoj and his team, I was able to very quickly put the entire allocation to work. I was able to immediately get diversification that I would not have gotten if I had, had to wait for capital to call, and kind of one asset at a time on the private side. And then I was able to do it really at a fee drag that helped kind of when you're starting a portfolio, especially, it kept me out of the J. And so from that perspective, and the thing that I think that I didn't really realize, and Manoj and I talk about this a lot, is the information flow. As you if you view it as a strategic allocation and it's a complement to each other and part of a big portfolio, there's only so many assets and there's only so many people who are investing those assets. And really the information flow that goes from the private side to the public side and vice versa is invaluable. So I think really having it sit there as a strategic allocation as a part of your broader portfolio, infrastructure portfolio is really helpful.
Yeah, I like that information flow. So are there any rules of thumb of percentages, or if people have a bias towards private, then they do listed at this percentage? If they have a bias towards listed, are there any things you see that are general, or is it, because I know people approach it from a lot of different perspectives, but maybe max allocations and some of the different allocations you've seen?
So keeping in mind that we are a private markets investment consultant, what we mostly see is just a small sleeve maybe on the side. And sometimes we don't even really see it, right? Because it's being handled by the public team. And so we don't even really see it. But if we do see it, it's kind of, maybe, I'm very much coming up with numbers off the top of my head, but say like a 90-10, right? So it kind of favors, but that's a matter of who we are in the market, focusing on the private side.
And we've also seen, I don't know if you would see that side of it, but we've seen from the listed side, big traditional private players who wanted it, even if it's just for a liquidity bucket, right? Because if you're massive and you have 5 or 10 billion in private, you might want 500 or $1 billion in listed for information flow, for liquidity, and for recycling funds. So
yeah, absolutely. But I think you have to really be cautious not to think of it as your ATM. Yeah. So when your capital calls come in, you don't want to have to, sell your listed side really indiscriminately. So I think as long as you think about it and you think that you're maintaining a strategic allocation over time, kind of regardless of, it's not always going to be static in terms of the breakdown, but you don't want to be forced to kind of sell the listed side just because capital calls come in.
Yeah. Can we talk about valuation for just a little bit? Because I feel like on the real estate side, and if anybody wants to share a perspective, we do talk about the dislocation between public and private. Like, for example, right now, people would say kind of the listed side of real estate's taking its medicine now a year and a half ago, and there's this kind of slow grind down on the private side. I feel like you don't hear as much discussion in infrastructure around valuation as you do in real estate. Maybe you can tell us why, or why you think that is. Fraser showed some good charts in terms of the valuations by sector, and you can see those online and also in the latest GLIO journal, that there is a pretty, significant disconnect in terms of valuation. These listed assets seem to be a bit cheaper, but can you just talk about valuation and maybe if or how that enters into investors' minds?
Yeah, and this is what I was talking to Fraser about before as well. I think that we might get 5 years in the future and start looking back at our 2023, 2024 vintages and realize maybe they aren't the best of all the vintages, but time will tell. Here's the thing. When rates were really low, and the discount rates didn't really change is I guess what I'm getting at. So we've been pulling all of our GPs down at kind of the asset level and saying, okay, list all of your assets, list where you had your discount rates a year ago, and list where they are now. By and large, no one's changed them. And so does that mean the valuation hasn't changed, or does that mean we're going to have to take some medicine in the future? It's also really hard to tell because there's still a ton of dry powder out there. Yeah. And that dry powder, I think, covers up a lot of sin because it kind of creates this demand where people are still trying to allocate. And so, on the one hand, there's not a lot of capital out there because everyone, we're all tired of talking about the denominator effect, but it has a real impact on how LPs are investing their allocations. But on the other, we have very few clients who are actually at their allocation for infrastructure. And a lot of them kind of seeing that it did do what it was supposed to do in this kind of macro environment actually increase their allocation. And so now they're even further behind. And so as long as that continues, I think it's going to be kind of hard to tell what's going on with the valuations.
Yeah. Chris, can we stay on that theme a little bit in terms of the talking points that Manoj or Jim or I might give for GLI, greater liquidity, diversification, transparency, and so forth? How do those talking points resonate with investors versus maybe the private side or other options? Are they valued, not valued? I know the argument maybe the private side would get is more specific, more direct exposure versus kind of broad exposure. But maybe just how do you think about the talking points on both sides and how those resonate with investors?
Yeah, no, it's interesting. Yeah, that's something we obviously spend a lot of time talking with clients and investors about. And it's funny, just on the point of liquidity, private markets, there should be a discount for that illiquidity, and that rarely seems to happen. And if anything, it's kind of the flip side on the public market side. I think more than anything, it kind of comes down to education, because when clients understand the value sort of inherently in investing in infrastructure, especially over the last several years. It's in the news. You see, bridges that need repair. You see the Inflation Reduction Act. The need for the energy transition. So it's in the sort of conversation of society more than ever before. So people inherently understand the importance of investing in infrastructure. They're hard essential assets. The inflation protection characteristics are super key, like they've never been, probably for the last 10, 15 plus years. So there's sort of this understanding and willingness to talk about investing in the asset class. I think a lot of clients, when they think about infrastructure, that they immediately go to private. That's just kind of where their mind goes, like, oh, I should invest in a toll road somewhere, or a pipeline, or whatever it may be. And walking through sort of the characteristics of what a publicly traded GLI strategy looks like, the diversification, the fact that you're able to get this portfolio that's multi-sector, multi-industry, multi-geography, kind of out of the gate. Those are really salient points, and I think it's just sort of opening that door to a lot of clients who just inherently kind of default to a private markets mindset.
Yeah, kind of good. Thank you. Ashli, maybe just coming back to you. What are some of the gaps? We get asked this all the time, and so I have my prepared answer, but what's your answer if someone says, well, if I do private, what exposures am I getting? And if I do listed, so let's say they listen to Chris and they say, okay, liquidity sounds great and diversification sounds great. What am I buying? And how would the assets look different if I did private versus listed? So where are they the same? Where are they different?
Yeah, there's a lot of overlap, I think, especially when you think the big themes that we have in the market now that we're talking to everyone about is digital and energy transition. So if you think about like the digital space, that started on the listed side, really, and then kind of later I think was more picked up. Energy transition, you can get utility scale renewables on the listed side. I do think that in terms of gaps, I talked about the real development of moving out in the risk spectrum. So we call it infrastructure adjacent. or opportunistic infrastructure well out there. You probably missed some of that, especially kind of on the new technology with energy transition. So that might be one of the gaps. And, but if you think about like on the core side, there are more listed utilities than there are unlisted utilities. And then if you can get one on the private side and, it's doing all the things you want it to do, you surely don't want to get rid of it. So it makes it kind of hard to, sometimes hard to find them and buy them. But I think really, if going back to kind of the complementary idea, you can really get the whole, you can do everything pretty much on, either on the private side or on the public side. But I do think some of that, like more, we'll call it juicy stuff, if that's where you want to play in the market. I don't know. Manoj can tell me I'm wrong, but I don't know that that's in the listed side.
And maybe in transportation and toll roads, there's options on the listed side. There might be more options that are held privately or smaller options. Perhaps some of the listed companies are a little larger, like a Transurban or.
Yeah, well, and the funds are getting bigger and bigger too. So it's actually, we are constantly, we like the middle market, and we think that's where there's a lot of return to be had, as opposed to kind of the big, there's a lot of competitive dynamics in the larger end. When you kind of move down to the middle end as well, like you end up with a lot of inexperienced managers, because everyone wants to scale, because if you scale, you get more fees. And so we find that actually the middle market to be a very, very good place to play. But, we're lacking kind of people who've done it over a couple fund cycles and really know how to do it.
Oh, I had no idea fees played a part in this. Thank you for
Look, I'm jaded. I've been an investment consultant and doing this for a little while, and so maybe I'm a little more jaded about it.
Yeah. Gosh, time goes quick, and I want to leave a little time if there's any questions. Actually, just while we're on allocations, any questions for Ashli or Chris, or any comments? We just have about 5 minutes left, I think. Is that right? Yeah, go ahead, please.
Comment on client experience. Make these points that you talked about, the salient points on liquidity and diversification. What other things come up, like the difference in leverage, like the true client experience you touched on? Is there a liquidity premium or a discount? Are they paying up for that? Those kinds of things come into the conversation.
Yeah, it's a good question. Fees, definitely. Yep, fees definitely come up, and that's where the listed side is definitely more competitive. On the topic of leverage, that hasn't come up as much in the past, but it's coming up more and more, as you would expect. Probably a little bit more kind of on the real estate side and the energy side, but it's definitely a topic that folks are diving into, and I think there's some good examples that maybe Manoj or others will talk about on the utility side, especially in the UK, where that's really coming into very, very clear focus. But yeah, I think certainly like the questions around debt and leverage will be even more salient as time goes on.
Ashli, have the private funds had to stretch on leverage at all, given higher interest rates and return compression?
Well, it's an interesting thing, because it's also a question we ask every GP we talk to, and we actually go out and polled them as well on the availability of debt. And I think, except for maybe on the digital space, where some of the banks are saying we have enough, they're still lending, and they're doing it at rates that maybe, especially if you're in one of the like energy transition sectors, you might not have even seen your rates move that much. But in general, yeah, I'm looking at, what I'll say is, I think people learned from the financial crisis on how not to put some kind of funky leverage structures onto your assets and then have them, go sideways. And sometimes I even look at investments more and more, and I'm thinking, oh, wow, you could lever that up a little bit more, being very conservative. But I think, to their credit, they don't want to have to kind of go through, the lessons learned, I think is the key, not to go back on.
So maybe in a little better position because they came into it a little better.
Right. And so I have talked to some, some of the GPs, and the banks are still lending, but if the rates have gone up, where I thought there might be a crunch is kind of in these development guys who, had some construction debt on a project and then had to kind of convert that over, but the rates are much higher. And so there are some of those conversations happening where they're saying, okay, maybe we should go in all equity, or maybe we'll just hold off a little while and see if the rates come down. But we're getting kind of to the end, I think, of that. You really can't wait much longer. We've also seen, and here's again me being a little bit jaded, stated. I don't know if there's actually interest in the market about this, or if there's just people fundraising about this, which is creating interest in the market. But there's been a whole lot more infrastructure debt funds that have come up. Now, there was a time when I was having 3 calls about that a week to go over and talk. And so we really built out our coverage in that space just so we could make sure that we had the best ideas to kind of put forward. I think we had 1 client invest. And so, you know, if you do find yourself in a situation where, you know, maybe you can't get the debt that you want from the banks, there are other alternatives that are definitely out there and popping up.
Good, thank you. Just in the time, maybe, yeah, quick question.
Quick question, especially in the UK, there was a rush to come up with investment trusts in the infrastructure area, and now they're all trading at very, very large discounts, and some of them got into the trouble. Lessons can be sort of learned from that, and how much is it affecting the market as a whole?
In 1 minute or less.
I suppose that's one for me. Yeah, it's exactly right. I think the immediate effect is that these investment trusts were built as you know, vehicles to grow, and obviously, if you're trading at a discount as an investment trust, you cannot issue equity. So that has derailed a lot of business models and plans, and also has a knock-on effect that the utilities and the developers who want to recycle capital by selling stakes in operational assets are not able to do that. So, you know, that's a real problem at the moment. I guess what it also tells you is that, you know, do you need 20 UK infrastructure renewable focused investment trusts? No, of course you don't. And so ultimately the market will weed out the poor assets and the poorly managed trusts, and they'll be wound up, or they'll be taken over by the others. And so you will get that kind of survival of the fittest, which always happens in markets, and I think needs to happen after 10 years of, you know, pretty let's say free and easy issuance by anyone who had an idea.
Yeah, good. We're about at time. Manoj, do you want to maybe wrap us up with a couple thoughts on outlook for the next 6 to 12 months? What's interesting, what's concerning? I know we probably didn't have time to get into some of the wind issues with Ørsted and others, which are a bit of a challenge right now, but what are some things you're excited about? What are some things you're kind of keeps you up at night?
Yeah, I mean, I couldn't help it. I looked past you. I saw it said like utilities, worst performing sector today. But yeah, I mean, listen, I think right now anybody that's in investments, it's all about what's the new baseline for interest rates. You know, until we can, you know, have some kind of, you know, understanding of what that's going to be, then you know, I think a lot of asset values are still going to be in flux. I think in the environment right now, I mean, I'm very, very much in favor of the barbell approach, right? You know, you want energy. Energy is in structurally tight. And so a lot of the existing energy infrastructure companies are in great position to take advantage of just a very tight environment, and the value of their assets continue to go up because it's now extremely difficult to build anything remotely close to a hydrocarbon-based energy infrastructure assets. And then now you're starting to see some pretty meaningful value, you know, in areas like towers and parts of the utility space that have been significantly impacted by the rising rates, and now their equity value has more than accounted for the current interest rate environment. And so I really do think that, you know, you want to play both sides of that, just because, you know, if this inflation sticks around longer, you want to benefit, and then, you know, if we do get some kind of reversion or a slowdown in the economy, or, you know, pause in rates or things like that, then you're going to see I think you're going to see some pretty decent pickup in some of these parts of infrastructure that have been quite weak the last 12, 18 months.
And wind still a challenge for a while, or is the problems behind us?
You know, on offshore wind, Yeah, I mean, I think that's sort of a, it is an issue that has a direct, it's a primarily a Northeast US issue. And I know, I'm sure one of the panels later will talk about some of the challenges behind that, but I wouldn't call it a complete anomaly, but it is very kind of specific. You're not seeing those same issues in Europe. So I do think it's a US centric, situation that will resolve itself one way or another, but it is a bit uncertain right now.
Yeah, good. All right, well, thank you so much. Please join me in thanking our panelists.